It's Arjun, Head of Research and Director at InvestorKit, and we're back for another episode of the InvestorKit podcast. Today I've got John here with me from the C2 Financial Group, and we're diving deeper into the world of self-managed super funds. Self-managed super funds were a very interesting topic that we'd done an episode on a few episodes ago, and the team here got inundated with inquiries around self-managed super funds setting up actually to start buying in them, or actually even just considering if their current ones are appropriately being managed. Now, this made me realize that we should go deeper into this because a few questions came out from it. So I thought, hey, why not get John on from C2 Financial Group, who's had over 1,500 plus self-managed super fund, set up, management, maintenance, experience levels. So this is just huge and almost second to none. So when it comes up to this space, there is no person better than actually having John here with me to go through all the insights of common mistakes, what some of his best clients do in terms of the ones that have performed the best, and even the opposite, the ones that haven't gone so well, as well as diving into some different swim lanes, things around commercial, business owners and how they can look at managing funds, and even considering some of the facts around insurances within your self-managed super funds. So we try and make the complexity of SMSF come down a little bit. John is a very technical person and someone who's an expert in the self-managed super fund space, so I'm confident you'll get tremendous value. Now, before you jump into this episode, if the idea of setting up a self-managed super fund has come up, or actually looking at your self-managed super fund that you've already got set up to start investing in property, reach out to us. arjun@investorkit.com.au is my email, or you can jump on our website to book in a time if you want to avoid the back and forth on email, and that's investorkit.com.au. We can have the team connect with yourself to be able to have that initial discussion around property investing. In terms of self-managed super fund, the sweet spot, in my opinion, is anywhere between 150 upwards in balance. The closer you get to 200, the more, buffer you can have. But at minimum, that 150 and going higher from there to be able to start to diversify some funds nicely. I hope that helps. And if you'd like to have a chat, reach out and you'll get a lot of value here because we'll introduce you to John as well to have a chat about setting up or management of your SMSF, and you're in the right hands. Thanks and tune in. John, thank you again for joining us on the show, mate. And I know you and your business partner, they're coming from a deep, investment background in equities as well as corporate tax. But more importantly, with more than 1,500 plus self-managed super funds under your belt from an admin side in the past, and I'm sure even growing now, how has this helped you two in the journey that you've been on in creating a difference for customers through self-managed super fund, but also, your familiarity and experience with this all?
Well, my brother and I, Marcel, who started C2 together, we started in equities and stockbroking in the mid-2000s. And back then, SMSFs they'd been around, but they were in their infancy for the mass population. And really what led us into self-managed super funds was clients of ours wanting to use their super to trade in equities. That was predominantly the main driver behind the demand for SMSFs back then, because you couldn't. Nowadays, you can, a lot of the big APRA regulated funds, you can trade equities directly if you want to. So you don't need an SMSF just for that particular reason. But what we saw in 2012 is when the ATO released some rulings around borrowing in super, and that's when we saw the opportunity there. At that point, we had a lot of clients coming to us wanting to buy property in super. So we really swiveled and moved our business to focus more on the SMSF administration side and kind of gave away the stockbroking and the equities trading and moved to specialise predominantly in property and super, and also in SMSF administration for advisors and self-directed clients. So we've seen that transition happen. I mean, now that these days, really, unless you wanting to buy unlisted assets such as equity, shares in a company or units in a trust or property, they're kind of the main reasons why people use SMSFs these days, because there's not much of an advantage of doing it to buy managed funds or just to buy equities, as you can access it usually through an APRA regulated fund, unless you've got a really big balance where the fees make sense. That's where we see the advantage in an SMSF.
Got it. And we'd looked into, I guess, when you look into SMSF, the big things are quite obvious when it comes to you can buy property or you can have more control or you can have investments into stocks. However, there's also some, I guess, more little known or very interesting rules. And look, you could look at these from a for investors or against investors. But in the SMSF, what are some of those little known rules or interesting rules that you can take advantage of that typical investors just might not be aware of?
In terms of property, I think there's one of the key ones that a lot of people don't know when they're starting on this venture is redraw facilities. So with a normal investment property, you can, if there's equity in that property, you can go to a bank and either if there's no debt on the property, you can ask to take out a loan against that property and use that money to expand your portfolio, put that money down for a deposit on another property, for example. With a self-managed super fund, you can't redraw against the property. So what that means is, let's say you had an SMSF and you paid $500,000 for a property, and a couple of years later, you really like the look of another property that you wanted to buy with your super fund. You couldn't go and draw out, say, $200,000 of that equity against the first property to use as a deposit on the second property. So what that means is that you need to be a bit more crafty at the start when you buy the first property. And offset accounts are a very good way to engineer it so that you can still have access to your equity to buy if you're looking to build a property portfolio in super. The reason is just for a simple example. If you bought a property, say today, for $500,000 and you had the choice of either paying the full amount, $500,000 out of cash out of your self-managed super fund, or you could take out a loan of, say, 70%, so a $350,000 loan. The reason, and that loan came with an offset account. The reason I'd choose option B, as in gear it to $350,000 and take out a loan with an offset account, is that when you buy this property, you'd pull $150,000 out of SMSF's bank account to pay the 30% deposit on the property, and then the remaining 70%, the $350,000, you sit in an offset account against the $350,000 loan. So effectively, you're still paying 0% interest because you've got an offset account that's fully offsetting the interest on the loan. But then secondly, though, the advantage of this compared to the option A is that you have access to that $350,000 down the track if you wish to buy another property. So that's pretty powerful. So you end up effectively in the same position as someone that didn't take out a loan anyway, because you don't have any interest expense because it's fully offset, but you get that added advantage of having access to the equity. So that's a pretty powerful weapon to have in your arsenal there. So some other rules that people, a lot of people are, to give credit to people, they're becoming a lot more savvy about the rules, but related party rules is probably the key area that people get stuck on. There's an overarching rule in self-managed super funds called the sole purpose test. And what that means is that you cannot use, or what effectively means you can't use the assets of your super fund for any personal use. The assets of the super fund can only be there to provide for your future retirement income stream. But what does that mean practically? Well, you can't buy a property from yourself if it's residential property. So if you had an investment property that you really just wanted to release some equity from and have your super fund buy it, you couldn't do that. You also couldn't have a related party living in your self-managed super fund, living in the property owned by your self-managed super fund. That's not a common mistake, but you do have a lot of inquiries that come through and say, if I buy this property, can my daughter live in it, for example? And the answer's no.
Have you had any left field scenarios in that thing? Because I always I'm not sure if you recall the GFC, Big Shorts, and all those type of videos, and how people were putting loans and things in their dogs and cats' names and all that craziness, right? But has anyone ever come up with a crazy scenario but what if it's my uncle's friend's brother / doing just something like that?
Yeah, there is, absolutely. People always try, there's always a grey area somewhere in the rules, but the issue with related parties is it's a very, very broad definition of what a related party is. So, for example, even though it might be your best mate, for example, a best mate isn't a related party, but if you two are a director of the same company, for example, then that person would become a related party. So it's a very wide-reaching definition of related party. And at the end of the day, it comes down to the trustee of the SMSF to make that decision as to whether or not they think that person would be related. But you don't really see. I mean, people either go into it knowingly that they are not going, knowingly that they're not going to be anywhere near a related party. They're just going to rent it on Domain, for example, and take whoever comes in. And then people that are thinking like that often know already what the rules are. So they're not really asking me to justify it. They're kind of asking me, who's going to find out? He's kind of the answer to that. So
at least they're not saying my dog is the party here, and they let me in the house from time to time, and they let me come through.
So the other one is out on that front is that people, the ATO give a good example that a holiday house, for example, is one that people say, well, I rent it out 90% of the time. Can't I just use it for 2 weeks over the Christmas break? And the answer to that would be no. But there is an exemption to the related party rules, and I think we'll cover that later in this podcast, but it's around commercial property, business real property. There is some rules around that as well.
I mean, on that note, when you think of managing SMSFs, this leads on to the next question, which is around some of the common mistakes. Now, that's kind of where one mistake can come up for sure. Are there any other common mistakes that you see that investors make when they're either setting up or even just managing assets in that?
Yeah, you see them all the time. Most of them are solvable. A lot of administrative errors just to cover off the boring stuff. Not having proper documentation in place to, the plumber comes around, for example, and you pay them $500 to fix the downpipe, and not keeping the invoice, or the invoice isn't made out to the correct entity. It's made out to you personally rather than to your super fund. As simple as that sounds, each year you have to remember that not only does the administration and accounting firm produce the financials, tax return and financials for the trustees of the fund, but where it gets difficult with a self-managed super fund is that everything that goes through the bank account of the SMSF or doesn't go through the bank account that has to do with the SMSF needs to get audited by an independent auditor. So that independent auditor, if they see a $500 transaction come out of the super fund and says plumber, they're going to need the documents to match the transaction, so the invoice from the plumber to the SMSF. The reason is that when you log into a bank account and you transfer $500 to your friend, you can write whatever narration you want. I could transfer you $500 and I can just write plumber on it. It's clearly not for the plumber, so the auditor needs to have some sort of backing evidence to prove that transaction is actually for the plumber. Without, there's ATO administrative penalties that can be applied. Probably not for that sort of that sort of materiality on an invoice, but you get the idea that documentation is really important to keep properly in an SMSF, and you see a lot of, and that's probably the most common mistake you see is around documentation, because it is a lot more onerous than just a typical investment property where you don't need to have a set of financials most of the time, and you obviously need to do a tax return, but you don't need to have a set of financials, and they don't need to be audited for most people. So that's what a lot of people that haven't done it before will find is one of them, probably an annoying thing and a mistake that they make, is that they just don't have the documentation in place. And an admin firm like us will remind you of what you need and bits and pieces along the way to make it easier for you. But at the end of the day, you still need to keep that in the back of your mind. But things like setting up a fund, we get a lot of takeover funds, which is a fund that's already in existence that come onto our platform. A lot of the time from online providers, because where you don't have anyone to help you at all. With property, there's quite to someone that's not in the game or not in the in the business like we're in the business of, it is quite a complicated setup, the structuring required. There's 2 companies that are required. There's a Bear Trust, there's an SMSF trust. The name that you put to buy the property is different to the name that you take the loan in. So it can be a complicated process to set up the fund. And so we get a lot of clients that have come to us that have gone online and set up a fund, and then all of a sudden they've realised that they've already signed a contract to sale for the property, but there's so many things that haven't been done yet. The Bear Trust hasn't been set up at all, or if incorrectly. And a lot of that one, for example, can be very costly to unwind that. Double stamp duty could be possibly payable to try and unwind that transaction. Or for example, the ABN hasn't been approved properly, or they can't do the rollovers because the ABN hasn't been registered properly with their bank account. So there's a lot of technical aspects around setting up an SMSF to buy a property that people that try and do it directly will often stuff up, to be honest. And so we end up with a lot of clients that come to us from other providers where just to give them assistance on that front. Some other areas where there's a lot of, when you're buying it, you really need to work out what the strategy is that you want to do and have your investment strategy in place before you go ahead and set up the fund. You do see people that come along that will set up the fund and they won't actually do anything with it for 12 to 24 months, which is fine. I mean, that's what your strategy is. Like, you might just be waiting for a reversal in the housing market or whatever it might be. But it's very much worthwhile having that investment strategy in place, so you're very much involved with it. You know what's going on, and you can execute it as soon as you're ready to do it. The disadvantage, obviously not as bad as it was the last few years, but sitting in cash, the interest rates are pretty low, and the equities market's flying. Probably in your normal super fund that you're in, there really wasn't much point in setting up that fund at that point. You should have probably just left it where it was for a year or two while you waited. It takes about a few weeks, about a month or so, to set up a fund. So it's not as if you have to have it ready 2 years in advance. But for property in particular, there's a lot of rules around the difference between maintenance of a property and improving a property, around what sort of you can use, what areas either maintenance or improvements can you use borrowing for, and if it's already subject to a loan, if you improve the property so much that it becomes a different asset, you've also got an issue.
Right.
So borrowing in super is a whole other area, which I can dive into, but it's a complicated area around repairs and improvements, and where's the line in the sand between that. And the ATO gives a lot of good guidance on that. But it's a simple example. I'll give you a simple example. If you were to buy a house in your super fund with a loan, and you wanted to subdivide it, that is an improvement to that asset, which would be significant enough to create a different asset to the one that the loan was initially taken out for. So you'd have a breach of the lending rules there. If you, for example, house and land packages don't typically work in an SMSF as well. 2 reasons. If you borrow to buy the land, which most people often do in a house and land package, and then you use cash, for example, to go and build the house on that land subject to the loan, you've breached the lending rules in super, because you don't have a vacant block of land with a loan against it. You've got a house on that vacant block of land. So it's a significant change in the asset. Things like just building a veranda or putting a swimming pool in, or putting another bedroom, or renovating the kitchen or painting it, whatever, those sort of things are fine. But you can't use a loan to do those sort of things. You need to do it out of cash, out of the SMSF. So there's a lot of rules there and mistakes you see people make. But as part of our service, obviously we would, the clients would typically call us up first and run the scenario past us, and would check with our technical guys as well, and come back to the investor and let them know, whether or not they can, or things to watch out for before they do it. But a lot of mistakes. There's a lot of things that you can get tripped up on if you don't know what you're doing.
Yeah, it actually just gives insights to certain complexities that exist in managing and maintaining it, but also gives you an idea that when you know these rules that you've spoken about, you can actually use this information to take a step back and start to think of what that strategy looks like, because you may now rethink buying the most unrenovated property in a fund, as an example, right? That needs a lot of love, and suddenly it's hard to draw that line between the two of improvements and maintenance. So very good points there. Now, when you think about the opposite side, which is now those portfolios and managed funds that do the best in the space of performance, what are some of the things that you see in those SMSFs that do really well that you realized, hey, these clients have definitely started doing this, and it's quite a common trait across the most successful clients?
I would think that the most common trait across the successful clients, ones that have their strategy in place and know what they're doing in the fund all the time. So what I mean by that is that you get a lot of clients that come along and they see a property they like, they buy it, and then they've got no involvement in watching the property or anything to do with it, and it kind of just falls by the wayside. They get too busy to actually focus on it, and maybe there would have been a better opportunity to sell if they were there with their finger on the pulse. The ones that seem to do the best are the ones that all over it. They might have shares, property, managed funds and things like that, and they're watching it really closely, and they've got an idea on what's going on, and they know that they're pretty all over the rules, and they've just got their strategy in place. They've either hired someone who's really good to help them with it, an advisor, for example, or property experts, or whoever it might be. But they're the ones that they're up to date with their documentation. They know what's coming up. They know their tax. They've got a rough idea on their tax liabilities and how that works. But they've just seemed to, those guys, I don't know what it is, but they just seem to be able to pick their assets better, and they seem to be performing better than the ones that just try and sit there idly without paying any attention to what's going on. I think that would be the common trait.
very proactive versus reactive to things coming up, right? At least
Yeah,
it's sounding like it's all strategy, it's planning, it's attentiveness, it's being proactive versus someone just hanging on the sidelines for another A2 or Afterpay to come up and quickly jump
yeah,
into it or something. So
yeah, exactly right.
definitely. Now,
Yeah.
when you look at business investing, you talked about there being an opportunity where certain commercial aspects of SMSFs work really well and do get past or get through effectively on that related parties. And so this is where even from our side, when it comes to commercial property investing, we actually often see the best deals sitting between that 1 and up to sort of 5 million space. And the reason why it's the best deals, in my opinion, is competition starts to shrink in these bigger assets. You have the net yields, the lease lengths, the tenant types start to be a little bit nicer and better. But the cash for many people isn't a very common thing to be walking around with 20, 30, 40% deposits on large commercials like that. But this is where SMSF starts to come up as an opportunity. I've even started hearing about things where family members are coming together to create one big fund. Is this common at all? And what sort of pros and cons do you see to this?
I would say, we've probably managed 1,500 SMSFs over the last 15 years, but I would say it's not uncommon, but it's not common. It's there's a lot of administrative issues, well, not administrative, but also financial issues when you involve your children in your SMSF. Probably the two biggest ones off the top of my head is that one, the kids often, if you're a 50, 55-year-old and your kids might be, say, 20, 25, they often don't have much money in their super funds. You might have a couple of $100,000, but they might have like 10 to 20. And there's not a lot of point. Like, it doesn't really add a lot of value there having them on from a capital point of view. But the second point is that you're at such different stages of your life. Someone that's at 20, 25 is probably going to be a lot more aggressive than someone that's approaching retirement. So how do you balance that with your family members? For example, my parents, they wouldn't want to do half the sort of gearing strategies that I'd do with my fund. But so I could never be in that same, because when you've got an SMSF, typically you do not have a segregated portfolio between all of you. And especially if you're putting all your eggs into one basket, it's definitely not going to be segregated. So you're mixing your risk assets with your parents' less risky assets that they might be after. So, and the other point about that is that when your in 10 years' time, using this example, and your parents need to start drawing down a pension from that fund, and you don't, and as a 25-year-old, 30-year-old at that point, you don't want to, when the parents need to draw it down, there's legislative requirements that they actually draw down a certain percentage of the fund each year when you're pension phase. But the kids, the only way to often access that liquidity, unless there's enough cash in the fund, is to sell the asset, which kind of defeats the whole purpose of why you did it to start with. So if you had 99% of your cash in one commercial property, and the parents needed to pull, and let's say it was worth $1 million, and the parents need to pull out, say, $50,000 per year in minimum pension withdrawals around, say, 4%, then you've got an issue, because you don't have the cash to be able to draw that down. So the only way to get that liquid asset, you can't transfer out a portion of that unlisted asset. So you've got an issue where you might have to sell the property at that point. So there's a lot of differing ages of that proportion. So 30 years, it can have its disadvantages that I've spoken about. The advantage, probably one of the key advantages, is it would help you get a loan for the SMSF if you're looking to get a loan, because your serviceability would be much better if you had 4 people, applying for the loan at the same time and then everybody's putting in their employee contributions, and your income serviceability is going to be much better. But so I guess they're the pros and the cons at a high level of things to watch out for.
Yeah. Now, business owners, we talked about their component as well. If they're taking advantage of SMSFs, for example, their premises, could you walk us through how that works and why it would be an advantage for many business owners, I guess, to consider an SMSF?
Yeah. So as I mentioned before, you can't buy a property from a related party. One of the key exemptions to that is if the property is what's called business real property. So let's say you owned a fish and chip shop personally, for example, and you're a fish and chip shop business. If your super fund could, let's say that the building was worth $1 million, your super fund could buy that building from you personally. And so what that means is that you've effectively released $1 million out of your super fund into your own name, so then you can do what you like with that. It's just a transaction. And then the super fund then owns the asset from then on in. Now that your fish and chip shop business can also rent the premises from your own SMSF. Now that has to be done on an arm's length basis with an independent valuation on the lease. But that's where you see a lot of people using commercial property is when they've got a business such as a trucking business, for example, and they want their super fund to own the depot that their trucks park in at night or whatever it might be, and then the trucking business pays rent to the SMSF and commercial lease rates. So that was probably one of the main areas. Commercial property was probably the first big driver of property in super, actually, and as a percentage, it's still a bigger percentage than residential property is as an asset ownership within the super fund. It's quite an attractive vehicle for people that want an equity release in their own name, but also to get some big assets into their super fund as well. It's a great way to do it.
So just confirming, so not only can the business owner pay rent to a property that's owned by their business or owned by the SMSF, right? And so their company is paying rent to the SMSF property. But then another scenario is that the SMSF can buy a property from the personal director to operate in that fashion. Is that what you said there? Just want to clarify.
That's correct. Yes.
Awesome.
So when the property is classified as what's known as business real property, like a commercial office, for example, would be business real property, then the SMSF trustees, so the trustees of the SMSF, can buy that property from you personally. At an agreed, it has to be at market valuation, independent market valuation. Yeah.
Now, when it comes to SMSFs, there was one aspect there, business, but the other aspect as well that I don't feel many people know about, but I know you guys help with, is insurances. Because when people think of insurances like life and all these other aspects, I guess so many people don't even consider it firstly, even though there's so much debt in the picture. And partially, I think that could be to do with the cost that it carries, or the process or the belief of the process. But I guess, how can SMSFs play an advantage to helping people with this component of the costs and insurance premiums and other things like that?
I think a lot of people do know about it. It's just often a difficult and time-consuming thing to organise for your self-managed super fund. If you think about where your insurance is at the moment, let's say you're at Australian Super, for example, often that insurance comes by default as soon as you become a member. So most people who just sign up to Australian Super end up with an insurance policy and didn't have to do anything to get it because it's under what's called a group policy. So the insurance underwriters will just take the whole group of 10,000 Australian Super members and give them all one policy, and you get allocated an amount out of that group policy that you're covered for. So with an SMSF though, typically and most of the time it's done at an individual level. So you get individual underwriting done, medical checks, all that sort of stuff. It takes a bit of time and effort to go out and do it. So you find that a lot of people will just do what's called a partial rollover and leave a certain amount of money at their current fund, let's call it Australian Super for easiness, and then that Australian Super will keep providing their insurance on that side of the fence, but eventually they'll get around to do it in the SMSF once the dust settles and they've bought the property, and they'll come back and get some quotes. But it is often more expensive because it's a personalised property rather than a group scenario, and I think it just gets put to the back burner where people should really be focusing on a lot more, especially if you've got gearing. As you mentioned, something you should always be covered. Well, typically you should always try and be covered for at least the amount of debt you've got. So it's an interesting space. There is a requirement for SMSF trustees to consider the insurance, but there isn't one for them to have. There's not a requirement for them to have insurance. So I think that's predominantly the reasons why people don't focus too heavily on organising insurance in SMSFs.
Yeah, look, I think knowing that you can even have it come out of it is actually a big advantage on its own, because insurances can be from a few $1,000s to many, many $1,000s, depending on your scenario. So that helps on a cash flow sense, but also helps protect the family, because when we run property plans, we notice the biggest thing is not actually buying the place. It's actually buying it, holding it for 15 to 20 odd years, and then making sure you can get to little to no debt as possible, whether it be through consolidation by paying it down or whether it be selling an asset. Now, to know that that goal you've got ahead of you is still somewhat 20 years away just shows that there's a lot of shit that can go wrong in 20 years, right? That you want to make sure that your family, who you're probably doing this for, is well protected. So it's such a good part to actually mention on, just because I think many people, whilst they know about it, don't get around to it. So lastly, my friend, let's talk about, I guess, the complexity of setting up an SMSF. There's been many parts here where there's some interesting rules, gray areas, certain scenarios where it works, certain scenarios it doesn't. But it reminds me of, I guess, an Albert Einstein quote where he said, genius is making complex ideas simple, not making simple ideas. So the world of SMSF is often actually a very complex one for investors, but let's hear you make it simple to set up. I'd like to walk through a scenario where someone's listening to this and going, hey, it's about time that I set something up. Maybe I've got 200K balance, 180, 250, whatever it may be. And I want to take the time to catch up with yourself and the team to set up something. Could you walk us through the process?
Yeah, for sure. So if someone wanted to, self-directed client, they knew their investment strategy. They didn't want a financial planner to go through their situation and give their advice on what it is. So when we're talking about a self-directed client, what the process is that we would have a conversation with them, either Zoom or phone call, and explain to them what an SMSF is, give them a lot of literature to have a read of before going ahead. Things like trustee responsibilities is a good one, the sole purpose test, which I discuss. And just to make sure that, to give the client the information they need so that they can go and make an informed decision before proceeding. And that phone call usually is about half an hour. There's a lot of questions that they might ask, renovating, how do I, if I want to put a veranda on, how do I pay for it? Can I use a loan? All those sort of questions that you might have or might be thinking about. And then at that point, if they haven't spoken with a mortgage broker yet, would often recommend that they go and speak to a mortgage broker. The reason is that, as I mentioned at the start, you need to get your head around the investment strategy and what you're going to be doing. And if you're thinking about using a loan and you have no idea what sort of loans are out there, you can't really we can't create an investment strategy at that point. So having a chat with a mortgage broker that specialises in SMSF lending, because SMSF loans are different to a normal investor loan, will allow you to back solve your investment strategy. So if you walked in and thought, with $100,000 in your super fund, you might be able to buy $1 million property, and you went and set up the fund only to realise when you went to get a loan that, the maximum LVR you can get is around 70%, then you're going to have spent all this money setting up the SMSF for no reason. So the first port of call is usually have a conversation with us, then a conversation with the broker, then have a think about it, work out your strategy, see if there's anyone else you think you might want to have a chat to. And then when you're ready to go, there's a simple application form where you fill in what you want to call the SMSF, and we create all the structures that are required for you. We set up the bank account for you. We do the rollovers from your existing super fund for you. And so at that point, you're ready to speak with your buyer's agent or whoever it is that's looking after it, or yourself if you're doing it completely directly. At that point, you'd be ready for us to give you a name to put on that contract to sale. So we'd tell you, use Smith Bear Trust name on the contract to sale if you're using a loan. And then you can go to the auction, or you can put in your offer to the vendor. Settlement works pretty much exactly the same way as it does with an investment property. Your solicitor will deal with the vendor's solicitor, and obviously the bank gets involved at that point as well, and any other parties such as a buyer's agent would get involved at that point as well. And settlement happens just the same way through PEXA or similar sort of institutions like that. So, and then what then we see through all of our data feeds into the accounts of the super fund, into our accounting software, is that we then send you the requests for information. So the settlement statement, the signed contract to sale, and things like that. So putting aside the sale process of the property, to get the fund ready and up ready to go is about 4 to 6 weeks. Technically, the fund would come into existence on the day that the SMSF deed is signed and dated, which could be this afternoon if you really wanted it to. But we always tell clients to hold off going and executing a contract to sell at that point, primarily because we need to apply for your ABN and TFN as well on your behalf for the super fund. And that can take up to 28 days for the ATO to approve. And every now and then the ATO will actually hold up the ABN and not release it onto what's called the super fund lookup. And the reason why you can't, if it's not on the super fund lookup, is you can't set up a bank account and you can't do rollovers. So if you've already gone unconditional on a contract to sale and you realise I can't even set up the bank account, I can't do a rollover from my super fund, there's a good chance that you might, you'll forfeit the contract and any deposit you might have paid on that property. So it's a real risk. So you're usually better off waiting that 4 to 6 weeks until the funds have arrived into the super fund. It's a little bit quicker these days with electronic rollovers, but if you jump the gun, you could find that something could go wrong. So It's a well-trodden process. We obviously hold your hand the way through it to make sure that you know where you're up to and what needs to happen next. But it is a bit of paperwork to shuffle around at the start to make sure that you've got everything set up correctly and you're ready to go.
John, the SMSF King at his work. Thank you so much for all your time today. How can anyone get in touch with you and the team just to be able to help them, whether it be set up, taking over, so forth?
Yeah, just if you jump on our website, www.c2super.com.au, you'll be able to find us there. And also, actually probably the better one to use is c2financialgroup.com.au, or you just Google C2 Super and we'll come up. But that's letter C, number 2, Super, or C2 Financial Group. And otherwise, I'm sure I could put my details down somewhere for someone to get a hold of as well at the end of this podcast.
Awesome, mate. Well, a lot of great insights in the show, from whether it be business owners, the to-dos, the successful clients, the not to-dos, and of course, the simplicity in terms of the setup once you think of those components, right? Which is the team like yourself coming in to ensure that the actual fund setup goes compliantly and goes through the works. But realizing one thing I picked out was those who have successful SMSFs are those who are proactive, think strategy, think purchasing, not just using it so they can start playing around in the ComSec app and go crazy on a few different share trades. The main thing here is that's when all things align well. A good team around you, a strategy in mind, and the ability to think long term. So, mate, thank you so much for your time, and I look forward to catching up again soon.
Thanks very much. Bye.